All right, we're in. We got Darren Mitchell here, and then remind me again, Darren, which one of these is the latest book?
The Be the Bank's the first one. That's the one I'd recommend first. That's the one that explains the concept and everything I'm going to kind of go through tonight. The Infinite
Hmm.
Banking for Real Estate Investors, just real estate examples of how to use it 7 or 8 different ways. I'm going to go over a couple of those ways tonight.
Okay, well that makes sense. You just answered my question. So read this one first, and then read this one second, and I guess Darren's going to give us a bit of a summary on what's going on, and if you want more details, it's in the book. So I should say that I'm actually a customer of Darren's or a client of Darren's, whatever you want to call it. And I trust Darren with it. Um, he's good at answering questions and and putting it in layman's terms because some of this insurance stuff is like, bounce your head off the desk type of painful, like worse than accounting, no offense. But Darren's great at explaining it, so I like to have him on, and I think it's a good asset for a lot of people here who have um, capital in their corporations or extra capital personally if they're making money real estate investing or in their businesses or personally otherwise. Like you have to at least understand it and then say no. But I bet you're gonna have a hard time, once you fully understand it and how it implies and what the benefits are. So this is why I like to have this conversation, at least once a year. So Darren, why don't you take over and do your thing?
Cool. Okay.
Just
Let me share
before
my.
that, Paul, would you mind putting those two books up for just a quick couple of seconds,
I
please?
want to
Yeah,
have QR codes. You can scan them when in the slide here too. But
yeah.
what about Paul?
Okay.
Darren's
See the bank, Infinite.
Darren's
Okay,
They're
thank
both
you.
on
yeah.
Amazon.
Yeah, he's gonna say he's famous on Amazon, so you can look him up.
Perfect, thank you.
If there's a question, pop it in the chat. Don't worry about it, or we'll get to you. Promise. Yes, the fire has settled. I changed the channel to like not Inferno.
Okay, Paul, can you see a screen that says the power of combining infinite banking with real estate?
Yes, sir.
Awesome. Okay, thanks for the intro, Paul. And yeah, this is all I'm kind of going to talk about tonight. I'm going to talk about what I deal with a lot of real estate investors. About 80% of my clients are real estate investors. 90% of my clients would either be real estate investors or business owners. A lot of them are both. And I'm the first one to tell people this isn't for everyone. This I think one of the disappointments for me in my industry is there's people in my industry that think, it's they're a hammer and everything's a nail. This isn't for everyone. I think there's lots of people that are don't have enough money to pay their bills that shouldn't even think of something like this. Like, there's cheap term insurance for pure death benefit. But for the people that this is right for, and I think that is mostly real estate investors, business owners, and people with either savings, wealth, or making a decent income. It's a great fit for a portion of your money. I don't pretend to say this is what the only thing you should be doing. I think this is a base. So I want to kind of take this as the approach of all the wealthy people I've studied through the years, and that's really how I wrote the books, is studying what wealthy people do and just kind of share with you my journey of how I educated myself on what wealthy people do and intertwine that with infinite banking, which is certainly one of the things that wealthy people do, with an emphasis on real estate. So, Paul, I'm going to stop probably in like 10 or 15 minutes, just do a quick check-in, make sure I'm good. And then I'm going to leave lots of time at the end for questions. So, unless you're on fire and you want to ask me a burning question, I'll leave lots of time at the end, but I'll do a quick check-in with Paul in about 15 minutes. That sound good?
Run with it.
All right. So for me, my journey really began September 29th, 2008. People say, when's the day that this kind of hit you? So that's my buddy Murray. I was up salmon fishing for my once in a lifetime salmon fishing trip as I sold it to my wife that year. I've now gone 8 times, so it's tough to sell it as a once in a lifetime, but that trip was the first time. And September 29th, 2008, I'm salmon fishing, trip of a lifetime with my buddy. I'm on top of the mountain. We're fishing. And that's when the market started crashing. It was dropping 1,000 points an hour. This is the stock market. I was a traditional financial advisor, so I jump in my buddy's truck, drive to the top of the hill, get my old BlackBerry, try to get a signal to call to the office to say what's going on. And I felt helpless and I felt out of control. I was still in my 30s at the time. So, I had lots of time to bounce back, but I had clients in my 50s, 60s, and 70s. And I was like, oh my goodness, what am I going to tell them? What am I going to do? And that's when I made the decision that I'll never go through an episode like that again, where I'm not in control of my money or my client's money. So I went on this kind of education crusade for 18, 24 months, spent six figures of my own money, multiple six figures, traveled all around the world. And for the first time, I started paying for my education post-university. Instead of listening to what the banks want to tell me for free, or the insurance companies or the mutual fund companies, I started paying to attend conferences and accounting conferences and conferences with wealthy people. And the coolest part is, wealthy people are the most generous people in the world. You go in and say, how'd you do this? What do you do? What do you think about this? I had people invite me in their homes and tell me everything they're doing with money. Like, it's fascinating when you ask someone for help, how many people will help you. And what I really learned is it's not that simple. It's not that hard. If you want to be rich, do what rich people do. And rich people do three things really, really well. They invest in themselves, they invest in businesses, and they invest in real estate. That's it. That's the secret to wealth. And everyone that joins Control and Compound, and we get a growing team. We're looking for an admin person in Halifax if you know anyone. But we're growing our Toronto office because we do about 80% of our business in Ontario. We got a place in Waterloo. But really, this is it. And whenever I hire someone, I have them sit down and I go, I want you to think of all the wealthy people, guys from business, hockey, golf, I don't care, wherever you neighbors, all these wealthy people, think of how they got wealthy. And I can guarantee you it's one of these three things, or the Lucky Sperm Club. But everyone I know, this is what they've done. They've invested in themselves. They've learned a skill. They've attended webinars like this to learn some financial product or feature that they didn't know about. They started businesses and they invested in real estate. That's step two. And I'm going to come back to what step one is. They also do three things really well. Wealthy people like to become their own banks. I wrote a whole book about that. They don't follow traditional financial planning. I remember my old traditional financial planning days trying to tell a business owner, super wealthy guy, you should have a group RSP and then the fees will be really low and you can put your own money into this RSP. And he just started laughing at me. And he was like, you want me to put my money in a government program? He's like, come on, kid. And I was walking out of there, I'm like, man, this guy doesn't know anything about money. He doesn't understand how cool RSPs are. And I'm, no, meanwhile, I was worth nothing at the time and he was worth like 30 million, but because that's what they taught me in my education from the banks and the insurance companies, that no, RSPs are the only way. So they don't follow traditional financial planning and they take action. How many people come to these things, watch something and go, oh, it's so cool. I was at this conference. It was so cool. Well, what did you do about it? Wealthy people aren't afraid to make mistakes, take action, learn from their mistakes and move on. So I keep talking about be the bank, that wealthy people act like banks. Well, there's a famous Henry Ford quote. He said, it's well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning. Now, what did Henry Ford mean by that? Well, I'm going to show you what I think he meant by that, and I'm going to show you by demonstrating how banks make money. So this is a bank. Tom comes in and puts $100 in, and Jane borrows $100. Now, I got to tell you, when I was a kid, I actually thought when I put $100 or $10 or whatever in the bank, that they took it back, put it in the vault, put a little corner with my name on it, and they said, "There's Darren's stack of money." And then the next time I went in, they'd go to the stack and they'd get it. And, that's not really how it works, in case, people still think that. So this is how it works. Jane's going to borrow money. Could be credit card at 20% a car loan, 5, 6, 7, a mortgage at 6 or 7, second mortgage line of credit at 12. I'm just going to use a nice round 10% number here. And I'm going to say, okay, Jane pays 10% on that $100 and Tom earns 1%. So we're all smart people here. Paul told me everyone coming was intelligent. So we know 10 minus 1. So the bank makes 9%, right? They charge 10% and they pay 1% for Tom for his money. 10% minus 1% is 9%. Well, let's put some numbers to that, because that's not really accurate. If you buy something for $1 and sell it for $10, that's a 900% return. So what did the bank buy for $1? They paid Tom $1 for the use of his $100 for a year. And then they charged Jane $10 for the use of that $100. Not their money, Tom's money. The bank didn't have any skin in this at all. So the bank actually bought it for $1, sold it for 10. So that's a 900% return. Now it doesn't stop there, because the bank doesn't just loan that money out once. The bank's also going to do the credit card at 27%, the second line or the line of credit, the second mortgage, the mortgage. They're going to loan that money out 8, 9 times. So we got to multiply that 900% times 900% or times 9. So we're getting crazy returns, and that's how the banks make money. Now, do banks like this cash value life insurance? They freaking love it. So this is the US banks. They have to disclose how much assets they have in cash value life insurance. Bank of America, this is a couple of years old now. Bank of America, over $21 billion of cash value life insurance. Wells Fargo, almost $20 billion. So at the front of the bank, they like to tell you to buy mutual funds, but at the back of the bank, they're actually buying cash value life insurance. No different from the wealthy people. McDonald's was started with a loan from a life insurance policy. Walt Disney, the same thing. Walt Disney's famous line for us insurance geeks. He said, "You want to see a banker laugh? Tell them you'd like to start something called an amusement park at a magical kingdom. Could I please borrow a few $1 million and see them laugh?" So he started that with loans from his cash value life insurance policies. 50% of the US senators have it, all kinds of Canadians. In Canada this year, we just, for those of you that listen to my podcast, it just came out this week or last week. The updated numbers are $1.3 billion a year in Canada goes into this cash value life insurance I'm going to talk about tonight. Paul mentioned the book at the beginning, Be the Bank. If you want to scan the QR code here, this will take you to the Amazon link where you can buy it. The Kindle's 99 cents. The soft cover is like $9.99 or something. I'm not looking to make money on this. I'm looking to educate people and help people learn. So that's the book. Now, if we get into what the wealthy really want to do, is they want compound interest. Compound interest is the eighth wonder of the world. Apparently Einstein said it. Those who understand it earn it, and he who doesn't pays it. Okay. Now, how do we earn compound interest? Remember the compound interest curve in high school? We had this, hockey stick kind of curve. Well, what I learned from studying the wealthy is the wealthy are just like us. They want that compound interest, but the wealthy know how to stay on the compound interest curve, and middle-class people don't. Okay. Middle income earners don't stay on the compound interest curve. Wealthy people stay on the compound interest curve. So what knocks you off the compound interest curve? I got a whole chapter in my book about this called the 4 wealth destroyers. And if you don't get a handle on these 4 things, you're not going to become wealthy. Just it's that simple. These are the 4 things that are going to kill your wealth and knock you off that compound interest curve. No surprise, taxes is number 1. Taxes, the number 1 wealth destroyer. Then we've got fees, volatility, and spending. I think of spending, what people do is I think of it like a snowball. They roll a snowball, roll it. They get the base of a snowman. So they save money, they compound it, it's starting to grow, and then they spend it. Or the kids smash the snowman, put it back to a snowball, and then you restart the compounding. What we're trying to do is roll that snowball for the rest of time until you die, just like the wealthy, so we never stop compounding. In other words, we're never affected by taxes, fees, volatility, and spending. So to show you an example how impactful these are, I'm going to show it 2 ways. I'm going to use the old penny example. You've probably all seen this. A penny doubling every day for a month, what's it worth? But I'm going to incorporate the wealth destroyers. So this is a penny doubling every day, 1 cent, 2 cent, 4 cent, 8 cents, etc. However, 50% tax rate. So instead of having 2 cents on day 2, they had earned a penny on day 2, but they had to pay 50% tax. So they have 1.5, then 2.25, 3.125, etc. So at the end of the month, this person has $1,900, okay? And they paid their fair share, okay? So they've got $1,900. Everyone's happy. Still a pretty good month starting with a penny. Now, the next wealth destroyer is volatility. So this guy started with a penny, doubling every day. So 100% return every single day, and then 3 down days, okay? Day 10, 20, and 30, it lost 40%. Now, who wouldn't take this, right? 100% every single day, and he had three down days minus 40%. Doesn't really affect things. No big deal, right? So this person started with a penny and they've got $289,000. Now, why did I use 3 down days? Is it likely in your investing horizon, you're going to have 3 down markets in the stock market? I think it's really likely in the next 20 years to have at least 3 down markets. Pick 30 years if you don't believe that. Okay. Another one of the wealth destroyers is spending. So now this person buys a car on day 21. So they compound, compound, compound. If you look at day 22, they've got about 21,000 there. They traded in their car. They put in the 21,000, got a new shiny car, and then they're back to a penny. And they started doubling that penny every day. So the end of the month, they have $2.50. So $2.50 if we buy a car, 289 grand if we have volatility, $1,900 if we have 50% tax. But what if we could some magic way eliminate the wealth destroyers, just like the wealthy, where we don't pay taxes, we don't pay fees, and we don't have volatility? That penny would grow to $10.7 million at the end of the year. Now, I already know where people are going with this. Darren, I'm going to give you a penny and I want $10.7 million. That's not what I'm saying. What I'm saying is this is an example of how important the wealth destroyers are. So I'm going to show you this, and then I'm going to show you the actual numbers. So that's the wealth destroyers. If we look at one more thing on the stock market, again, just trying to educate you guys on stuff that your financial advisor is not going to tell you. Average return. This blew me away when I started studying the wealthy and learning this. Who cares about the average return? Every time I open the paper now and I see this mutual fund is an average return of 7.6% or whatever it is, drives me crazy. And I'll show you why. How do we figure out the average return? Well, if we had 2 numbers, a 6 and an 8, we add them together, divide by 2, right? 6 plus 8 divided by 2. So in this case, we have 4 numbers. So we're going to add these 4 numbers together and divide by 4. So year 1, we have 100% return. Then we have a minus 50. Then we have a plus 100 and minus 50. So if I were to calculate the average rate of return for those 4 years, I'd add those 4 numbers up, which equal 100. I divide by 4. I get an average rate of return of 25%. So, you know, if the advisor in this case comes back to the person and goes, listen, I don't want to call myself a rock star, no pun intended, but I just earned you 25%. So why don't you give me a list of all your friends and family, and I'll talk to them, and I'll be an incredible advisor to them too. But does anyone ever look at their investment statements and go, you know, it doesn't really feel like I'm getting ahead. My guy just keeps telling me things are good, but it feels like I'm just getting ahead by what I put into it. So if you do the actual rates of return here, if you started with $100,000 and in year 1 you doubled it, how much would you have? 200 grand. And year 2, you lose half of that, minus 50. You're down to 100. We're going to double it again in year 3, lose half of it. So at the end of year 4, your actual return is 0%. Do you give a crap that your average rate of return is 25%? You started with 100 grand, 4 years later, you still got 100 grand, you earned 0%. And I show this to people and they go, all right, Darren, nice little story there. But the stock market itself is never going to go up 100 and down 50. Well, here's the S&P 500 going back to 96. It went up 106, down 50, up 100, down 50, and now it's up over like 450%. It's just literally on fire for the last 15 years, ready to blow. So that's the volatility. The actual numbers look like this. Here's the S&P 500 with dividends. This is the rate. This is the granddaddy of them all, the best rates. This is a 20-year period. The actual rates of return each year are 20, minus 9, minus 11, 21, 28, etc. But if I add these 20 up and divide by 20, I get an average of 7.11. So I'm going to tell you a little secret now about financial advisors. This is what they do when you come to them. They take their little calculator, or they take their little computer now, and they go, well, Paul, how much money do you have now? Well, let's punch that in. What do we think we're going to get for an average rate of return? Well, the market average is 7.11. Let's use that. And then lo and behold, you got yourself a financial plan. This guy came in, he has 253,000. He's got 20 years to retirement. He's going to earn 7.11 on average. So boom, $1 million. Thank you. There's your financial plan. I'll see you next year for your contribution. That's what people are seeing out there. This does not account for volatility, does not account for fees, and it does not account for taxes. So what if I just put in the actual rates of return? Okay, remember the actual rates of return were these numbers on the right? If I put the actual numbers, rates of return in there and say a 2% fee. Now, the average fee in Canada is 2.2. You might get a 1% fee if you're high net worth or index fund, but for sake of argument tonight, I'm putting in a 2% fee. So just two wealth destroyers. A 2% fee and the actual rates of return, instead of $1 million in 20 years, you'd have 502,000. You lost half your money because they didn't include fees and the actual rates of return. Now, what if I take those wealth destroyers out and I just put in taxes? Only going to include taxes. It's the only wealth destroyer I'll include. And I'm going to say taxes are only 25%. Your $1 million goes to 465,000 at the end of 20 years. But we don't get to take out fees. We don't get to take out taxes. If I put taxes, fees, and the actual rates of return in other words, the volatility, the actual numbers. Now, this is not projection. This is the actual 20-year return of the S&P 500. That 253,000 there in 20 years grew to 332,000. So you thought you were going from 250 to $1 million, and you went from 250. So instead of making 750 grand, you made 75 grand. So 90% of your wealth was destroyed because of the wealth destroyers. So if you don't get a handle on wealth destroyers, you're screwed.
Sorry to interrupt, but I'd argue you might have made nothing or even lost money when you factor in an inflation adjusted return.
100%, Paul. Bang on. Bang on. Cool. So why don't we just stop, Paul? So I'm just going to get into one more thing and then jump into the infinite banking thing. But we good? We on track? No one blowing up? No one quitting? No one crying?
Nope.
Okay. So the other thing that, really learned about money, I don't know if you guys remember years ago, they used to have TV commercials and people would walk around and they'd have these like big numbers on their head. Like these, what's your number? 1.26 million or 574,000. And people would always like, this is how much I need for retirement. Well, I'll tell you a little secret. Nobody comes into my office in retirement and goes, Darren, how much money do I need for retirement? Their only question is, how much can I spend and not run out of money? So in other words, how much income can I take? So if income is the ultimate goal in retirement or cash flow, I think it's relevant to have that discussion before retirement. Because typically what people do is they plan for a number, 1, 2, 3, 4 million, whatever your number is. And then they don't think about what kind of income that can produce. In other words, what assets they're in. So what can you do with your money in retirement? And if we were to wait 20 minutes and come up with all kinds of alternatives tonight, they would fall under two categories because there's only really two things you can do with your money in retirement. That's it. You can spend it or you can give it away. There's no other options. You can give it away in life. You can give it away in death. You can spend it or not spend it, but that's pretty much it. You can spend your money or you can give it away. You can give it to charity, you can give it to family, you can give it to the government. That's it. So when you live off your money, let's say you got $1 million, the two most traditional ways to live off that money is one called the Monte Carlo. And the Monte Carlo is a fancy term. If you want to just Google the 4% rule, Wade Pfau actually does some great stuff on this, but there's all kinds of 4% rules out there. And basically the Monte Carlo is like 1 million simulations run with interest rates, historic market returns, and says, how much money can you take out a year and not run out in retirement? And the magic number is somewhere around 4%. Now, when we had low interest rates, they were saying it's closer to 3, maybe it's 4.2 now, ballpark 4%. So if you get $1 million saved, that's only 40 grand a year. That's really not going to be a lot for a lot of people to live on. And then if you think today, if you're making 100,000 today and you still have 20 years to go, if you're making 100 grand today at 3% inflation, in 20 years, you've got to be making 180 grand just to have the same lifestyle as 100 right now. So if you're going to retire in 20 years and 100 grand's your number today you want a year, well, you're going to need 180 grand. And to produce 180 grand the traditional way, we divide that by the 4%, is roughly $5 million. Now, I don't know many people that have $5 million in their RSPs. I don't know people that have $5 million in their RSP. So when I say the wealthy don't follow traditional financial planning, this is not what the wealthy are doing. Okay. Now, that was the first part. You spend it. Well, what happens if you die? So this is a true story. I had a guy come see me, and he was single. He was in his 70s. He had 4 kids, and this was his plan. I said, "What are you going to do with your money?" He said, "I got $1 million in my RSPs. I'm going to leave that to my 4 kids. I'm going to give them $250,000 each." And I said, "That's noble. I hate to break it to you, it doesn't work that way." What happens to your RSPs when you die? If you have a spouse, 100% of your money transfers tax-free to your spouse. So in this case, if he had a spouse, the $1 million would go to his spouse. He didn't have a spouse. Or even if you have a spouse, when the second spouse dies, what happens to that $1 million? In your terminal tax return, you're dead, it's terminal, your accountant does. Basically, they assume you cashed out your RSPs the day you died. So if your year of death, you made 100 grand and you had $1 million RSP, your income tax return would basically say you made $1.1 million. So in Ontario, that would mean you're in a 53% tax bracket. Now, this guy was in Nova Scotia, so he was lucky. He was in a 54% tax bracket. So his $1 million, 540,000 went to CRA, and $115,000 goes to each kid. Now, I want to know anyone with a financial advisor sitting down in their 20s, 30s, and 40s, did anyone get shown this slide here to say, did you know that Revenue Canada could be your largest beneficiary of your estate? That shit crazy to me. Okay. So I said the wealthy do 3 things. They invest in themselves, they invest in their business, they invest in real estate. And again, investing in yourself, that can be getting a real estate coach. That can be joining a real estate group like the one you're part of tonight. That can be listening to this webinar, reading my book, watching a webinar. It doesn't always have to be something expensive. It can be. Okay. I pay for all kinds of coaches. My coach told me to put the blue blockers on tonight. First time I've worn blue blockers. I'm part of Strategic Coach. I'm part of the 10X program. I'm a part of all kinds of coaching where I pay money to improve myself so I can grow my family's net worth and grow my business, etc. Now, I don't know if Warren Buffett read my book or how he heard about it, but Warren Buffett at the last Berkshire Hathaway meeting said, someone asked him, "Where should you invest, Warren, in a recession?" He said, "Same place you should every other year. The best place to invest is you." So I don't need to get into whether I stole it from him or he stole it from me. It doesn't really matter. Anyway. I put R&D down there. I taught my kids this years ago. I go, "Kids, you know what R&D is? You got to do it." And they go, "Yeah, Dad, research and development." I go, no. Rip off and duplicate. There's never an original idea out there. If you see one and you like it, take it. So invest in yourself. So I said that was step 2, you, business, real estate. What's step 1? So this is the hierarchy of wealth. And this I think is the most important slide, one of the most important slides I'll show you tonight. And I have a whole chapter of the book about it. Wealthy people will not give up control of their money. You will not see a wealthy person want to give up control of their money. In 2008, wealthy people made money because they were in control of their money. You know who lost money? People that had all their money in real estate and the stock market and didn't have access to money because the banks weren't giving money, and anyone that wanted money had to sell an asset at a major loss. I remember an accountant told me a story about his clients. This was a guy in Florida. He borrowed $1 million from his cash value life insurance policy and bought 13 additional businesses. He was a franchise guy for 13 cents on the dollar. He 10x'd his wealth in 4 years. And some guy puts up his hand and goes, "What was the loan on the insurance policy? What was the interest rate he paid on the loan?" And the accountant's like, "Who gives a shit? He 10x'd his wealth. He was in control of his money is the key here." So I believe the hierarchy of wealth looks like this. It's like a pyramid, and the most important part is the base. Just like your home, the most important part is the foundation. Without a rock solid foundation, it crumbles. This is the most important thing you're going to do, is build a base of your financial plan that's a position of control. And that's going to be cash or cash value life insurance. And I'll explain why cash value is a million times better. The idea that we would tell someone to invest in stock market and RRSPs and lock it away for 50 years, if you're a real estate investor or an entrepreneur, to me is batshit crazy, or at least for all your money it is. Because if a deal of a lifetime comes your way, I promise you, it's going to be because it's going to be because one person has money and one person needs money. I want to be the person that has money or has access to money. And I promise you there's going to be all kinds of opportunities come your way and all kinds of emergencies, and how you're prepared to deal with those will fundamentally change your life. Okay, so how does this work? So we put this money in this cash value life insurance. We're going to get into what the cash value is in 2 slides, but we're going to put money in here and we're going to say, great, now we're going to compound it on this compound interest curve. And we're never, ever, 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 ever going to stop compounding. It's going to grow, 5-6% tax-free every year. Okay. Plus we're going to have this death benefit. But the magic of this is year 1, 2, 3, 4, 5 in there. I don't care when it is. You go, amazing opportunity comes your way, or an emergency, but let's say an opportunity, and you're going to go, great, I am going to borrow against my cash value. And we're going to get into how you do that. And when you do that, your cash value inside your insurance policy is not affected. If you had 100 grand in there and you borrowed 90 grand, you still have 100 grand in your policy. It's not affected. You're using the insurance company's money. So now you have money inside your policy growing tax-free, and you have a death benefit, and you're doing the real estate. So it's the only and asset you will ever own. Everything else is an or asset. Do I join a real estate? Do I get a real estate coach? Or do I put money in my investment account? Or do I fix the house? This is an and asset. I'm going to put money in my cash value life insurance. It's going to compound tax-free for the rest of my life, provide me a tax-free retirement. Okay, tax-free retirement, because at the end, you're just going to borrow for lifestyle. Okay, so even if you don't take loans, it's awesome in retirement. But now we're going to compound it, and we're going to do real estate, and we're going to join a coaching group, and we're going to do this, and we're going to buy Bitcoin, and we're going to buy the market when it crashes, and we're going to buy the stock market when it crashes, whatever your opportunity is. The key here is we've eliminated or almost eliminated all these wealth destroyers. Taxes. The growth on this policy is completely tax-free. The loans on this policy are completely tax-free. The death benefit on this policy is completely tax-free. 3 levels of taxation gone. The fees on this, the average mutual fund charges a 2.2% fee. The fees on this are federally regulated, 0.13%. 0.13 versus 2.2. So we almost eliminated the fees. The volatility, it's effectively zero. The volatility is this much. 150 years, paid a dividend every single year, never missed a year, never had a dividend below 5%. Unbelievably not volatile in the least. And spending, instead of smashing that snowball going back to zero, when we want money, we leave our policy alone and we use the insurance company's money. So let's talk about some of the particulars of this insurance contract. So cash value life insurance is the product we use for the infinite banking concept. Gross tax-free, loans are tax-free, death benefit tax-free. Uninterrupted compounding. Again, we're not going to interrupt it for those wealth destroyers. It allows us to multiply dollars. Creditor protected. On a personally owned policy, if you go bankrupt or get sued, they can't touch this. You could literally have $1 million of cash value in your policy, declare bankruptcy tomorrow, and you'd still have $1 million in your cash value to rebuild your business. Okay. We use the word life insurance because this is a life insurance product, but it's not like any other life insurance product out there. In Canada, there's over 10,000 different insurance products, 10,000. There's only 4 that meet our needs. There's 4 specific products. 4 companies each have 1 product that we can use. This is what we call participating whole life, a unique product. And what we try to do, most people are focused on a death benefit for a life insurance contract. We're the opposite. We're trying to drive the death benefit down as small as possible to drive the cash value up as high as possible. Because we're using this as really a savings account, a tax-free savings retirement account. What I love about it is I get to save for the long term, my tax-free retirement in here, but I use it in the short term to keep doing deals over and over again. Okay. Uninterrupted compounding. And then I want to talk about these loans. So Dan, who works for me, some of you, I don't know if you've dealt with Dan yet. He came from the Royal Bank on the corporate side. And like, I'm teaching him this stuff. And he's like, this is like the holy grail of loans. You can't get loans like this at the bank. So the type of loan this is, number one, it's guaranteed. So whatever your cash value is, the only person you need to convince that you want a loan is the person in the mirror. So guaranteed they will loan you 90% of whatever your cash value is. If you have $1 million of cash value, they will put 900 grand in your bank account, no questions asked. They don't ask for financials. They don't ask if it's a good deal when you're paying it back. They just say yes. It's tax deductible. The interest is tax deductible if you use it for real estate, business, investment, something you plan on earning a return on. It's uncallable. There's going to be lots of lines of credit called, just like 2008 if the market takes another tumble. Okay, they can never call this. Tenants stop paying, rates go up, prices go down. Nothing they can happen. Nothing they can do. And then the last one here is huge for real estate investors and business owners. It is an unstructured loan. And what that means is you pay the loan back when you want, how you want, and if you want. I'm going to say those again. When, how, and if you want. Now, when I say if, we want you to repay the loans in the early years so you can use it again and again. But in retirement, I'm not repaying the loans. I'm going to have $1 million death benefit, say at 65, or cash value, and I'm going to borrow 100 grand a year. And my $1 million is going to continue to grow. So maybe we're 2.5 million of cash value when I die. I've taken 100 grand out for 15 years, throw in some interest. What happens now when I die with this big loan? Oh, there's a $4 million death benefit's going to come in, pay off the $1.8 million loan, and give my family $2.2 million or whatever the numbers work out for you. So guaranteed, unstructured, pay it back when, how, and if you want. You want to pay it back in a full shot in 2 months, no problem. You want to pay it monthly, and in year 3, the project gets screwed and you got to extend it 6 months. Great. Stop making payments, or borrow more, or pay it all when you finish your private loan or whatever you're doing. So completely unstructured deal. And why it works so well for real estate, if we look at the stock market, we put money in the stock market, we've got one job. Hopefully the stock market goes up in value. If we put money into real estate, you guys know this, 5 or 6 different jobs your dollar can do. What I'm saying is if we put it in the insurance contract, properly structured insurance contract first, and then we do the real estate, now we've got all these additional jobs. Uninterrupted compounding, death benefit, financial velocity, the unstructured loans, accreditor protection, terminal waiver. If you're dying, they'll advance 25% of the death benefit for more trip to Vegas or Disney. Tax-free transfer at death. I was able to eliminate $2,500 a year of term insurance because my death benefit got to a point my dollar was doing another job. And then this is huge for real estate too. Loans do not affect borrowing capacity. So you can take a loan for a down payment and the banks are cool with it. And I'll give you a real world example. These 2 lovely buildings right here are buildings of mine. Remember, people said, you bought a 4-plex for 375 grand. They go, that wasn't Ontario. I go, yes, it was, but it was Cornwall. Now, to put it in perspective, I paid 55 grand for a parking spot in Mississauga. So Cornwall, this was 375. It was actually 2 duplexes on 1 lot. So that was a bit of paid the ass. How did I pay for this? Brainwashed my children as always, since they were 10. They were teenagers when I bought it. And I said, kids, great opportunity to grow the family's net worth, great cash flow. Should I get money from my RSPs? You can't, Dad. That money's in jail. What about your RESP, education fund? Money still in jail. What about this beautiful cash value life insurance? You got it. I said, let's leave that there because I want to spend that tax-free in retirement. I called the insurance company, and I said, can I have 80 grand? Now, they asked me 2 questions. They said, Darren, do you want it deposited in your bank account or do you want a check? That was it. Okay. They didn't ask me whether it was a good deal. We actually went to the city. We get this lot separated into two separate pieces. We had to spend about 16 grand to put in new sewer pipes. There was one pipe going down the middle of these two buildings and split. We had to split it at the road. Paying down the cash flow. We're refinancing this property probably in another 3 or 4 months or in the fall. What am I going to do? I'm going to repay my 60, 70 grand policy loan, whatever's left on that. Still have a cash flowing property. That didn't affect my cash value at all. My cash value never was affected a nickel. I just multiplied money. That's an and asset. This is not the 39 unit building I invested in, but I invested in a 39 unit building, GPLP structure. I was LP, put 200 grand in, didn't use my money, called the insurance company up and said, hey, need 200 grand of your money. They loaned me that money at the time, was about 6% interest. Okay. It was supposed to be 24 months. This doesn't happen very often in real estate. It actually was better than advertised. In 18 months, I get all my money back and still own 3% of the building. So in 18 months, I get the 200 grand back. So what did that cost me? It cost me $9,000 in interest that I wrote off as a tax deduction, $4,500. So for $4,500, I now own whatever percent of a 39 unit building. I'll own that for life. The plan is every 5 years, they're going to refinance it and give me another 200 grand. Plus we're going to have cash flow. Okay. Private lending, same thing. Did a private lending deal when the borrowing rates were around 5%. Now the rates now anywhere from 6.5 to 9, right? They're up with the interest rates are up, but they'll be down next year when the rates are down. At the time, 5-6%. Loaned 100 grand out at 15%. How'd I do it? Called the insurance company. They gave me 100 grand of their money. Didn't affect my cash value. I loaned it to a developer at 15. He cut me a check for 115 a year later. Gave the developer gave the insurance company 105. I pocketed 10 grand. Just an and asset. Still compounding in my policy, the exact same. Not affecting my tax-free retirement. Not affecting my death benefit. Just multiplying money, just like the wealthy, just like banks do. So it's really anything you can use. Think of in a real estate example, this can be used for flips, buy and hold, land development, fundraising, you name it. It's literally the possibilities are infinite. That's why it's called infinite banking. We can do corporate owned policies that are super sexy, but only if you have a CCPC, which means really an operating company. If you just have a real estate corp, unless you have 5 employees, you can't do a corporate policy. If you have a corporation and you're in the real estate business, like you're an advisor or something, or you're an agent, 100%. That's awesome. You earn $1, you pay your 12% tax in Ontario, you're left with 88 cents. We can invest those 88 cents right inside the policy. Works great. Works great personally, works great corporately. But if you've got a holding company, you've got a bunch of money sitting in there in cash, we can eliminate literally 3 levels of taxation by doing it inside the corp. We eliminate the tax on the growth. We eliminate the tax when you go to get it out and spend it. And we eliminate the tax at death. Passive investment rules for those with holding companies where you're going to earn more than $50,000 of income. You get hammered in Canada. That's a 4th level of taxation we can eliminate it for. We can use this for businesses, short-term. Instead of holding on to cash in a business, you should be holding cash value. So your money's growing at 5 or 6%. You get the death benefit. We're multiplying money, all kinds of things, equipment financing, all those leases, cars, you name it inside a corp. We can do it all. So infinite banking, awesome. Real estate, awesome. Chocolate, peanut butter, put them together. It's even better. Reese's peanut butter cup. So the last couple slides here. Insanity is doing the same thing over and over and over again, expecting different results. So I would say to the people tonight, you got 2 options at the end of this. You can do nothing, stay where you're at, or you can actually take action and set up a time for a consultation call. These are the resources we have. We have a special link just for your group tonight. Okay. So if you go to controllandcompound.com/EIA, we're going to give you front of the line treatment. What does that mean? That means you're going to get an appointment with one of our wealth coaches, complimentary 1-hour session where you sit down and they just run through this concept in detail and say, listen, that bald guy talked really fast and was late at night. I didn't catch all of that. Can you kind of go through it and explain to me from beginning to end, how it works. If you go to controlandcompound.com/EIA also, there's going to be spots to buy the books. We've got a podcast, a very successful podcast with over 100 episodes you can check out. There's free webinars on there that you can watch to educate you on the topic. There's blogs, there's all kinds of stuff at the website. This is something that it's tough to grasp at the beginning, but once you catch it, it's really hard to uncatch, because once you understand it, it's hard not to say, why isn't everybody doing this? I'm going to grow my money tax-free. I'm going to have a tax-free retirement. Anyone think taxes are going to be higher in retirement? I'm going to have a tax-free retirement, and I'm going to be able to use my money in the short term to multiply my wealth in business opportunities, real estate opportunities, or stock market opportunities, or any infinite, we've got farmers that use this. We've got, you name it, we've got it. So Paul, I'm going to stop there because I wanted to save time for questions. But that was a quick overview of what infinite banking is. Be the Bank is the book I'd recommend you guys read if you want to learn more, and set up that education call. If you did it tonight, they'd actually call you tonight. If it's between 9 a.m. and 9 p.m., we typically call within 120 seconds of when you register. And that's it, Paul. I got questions if no one has questions that typical questions that I can answer, but why don't I open it up and you guys can ask what you'd like.
I got a question.
Sure.
Okay. So how quickly can you use the money? So if I was to get the insurance policy, say this week, how long would I have to wait in order to use it?
Great question. First of all, you couldn't get it this week. So yeah, typically it's 2 to 6 weeks kind of a process from start to finish, depending upon the health questions. There's 4 companies we use. One of them, I'll give you the worst case first and then the best case. One of them is 12 months in a day. So you put money in, and it's 12 months a day before you can get the loan. The other 3, it's the first month. It's technically the first day, but I'll be honest, I'm going to call it 3 weeks, because when you first set up a policy, they got to cash the check, deposit the check, set it up, send your paperwork. So you're 2 or 3 weeks. Now, I will say the other thing is, if you want to access the money in the first year and you need all the money you have, it's not the time for you to do it. So in other words, if you got 100 grand and you need that full 100 grand, because the way these policies work, year 1 is the hump year you got to get over, right? Year 1, you might have 70, 80% of your cash value of what your deposit is. So if you put 100 grand in, you might have 70, 80 grand first year, right? It's kind of like doing a renovation on a property. You're getting rich long-term. You're not getting rich year 1. So, but if you had 100 grand and you needed 50 or 60, well, great. You could do 20 grand a year in your policy, and great. You didn't need that 20. And by next year, now you'd have access to, say 35,000 of the 40 you put in. And then by year 3, you're growing by more than what you put in each year. So, or really at 24 months, you start growing by at least what you put in or more. Long-term, you're going to be all kinds of money in there.
Sure. Thank you.
Welcome.
Darren, I have a question.
Yeah.
So let's say I take out a policy for $100,000.
Yeah.
How much, and I need to borrow money a year from now. I want to borrow 50,000. How much money would I have contributed at a $100,000 policy? In other words, let me ask it differently. Do I need to put in $100,000 to borrow $50,000 a year from now? Or what do I need to put into that policy to borrow $50,000 a year from now?
Probably like 30 and 30, 30, 32 and 32. Like, you're going to be 80, 90% of your cash value at that point. So if you put 100 grand in there, your cash value is going to be ballpark 90 grand. You can borrow 90% of that. So 81 grand of the 100, like, roughly 80% there. Now, if we did that same thing in year 6, it would be the opposite, right? You could borrow more than what you put in, because now you would have had the growth. So it's just the first couple of years where you're underwater. Long-term, you're way above water. So like, let's use that example. Year 10, you put 100 grand in, you've deposited $1 million. Well, your cash value is $1,250,000. You could borrow $1,150,000, even though you only put $1 million in. But to you know, I'd guess 80% would be my guess, Paul. So if you wanted to put in 50, you'd have, if you wanted to borrow 50, you'd probably have to put in 63, 65 in the next 12 and a half months.
So in a life insurance policy, normally you're paying a monthly premium.
Yeah.
But from what you've presented tonight, are we paying the monthly premium? Or are we investing in like a, I don't know, like an account?
Yeah, so we're investing in what's called a participating whole life. But what we're doing is we're driving the death benefit down as small as possible. You can pay monthly on this, or you can pay annually. Like,
Okay.
one of the things we do a lot now, one of the companies allows us to actually, so like I would say pay annually if you're sitting on the money, but if you're not sitting on the money, pay monthly. Okay, you get a slight extra kick if you pay annually. It's not massive, but it's, you might as well, if you're sitting on the cash doing nothing, to pay annually. But one of the cool things we can do now is, let's say you said, I want to put in, 50 grand a year, 25 grand a year, 10 grand a year, doesn't matter. Let's just use 25 grand a year. But I'm sitting on a bunch of cash now. We can actually backdate the policy to pretend we started a year ago. So now we're going to put 25 grand in for last year and 25 grand in for this year. So in the first week, we put in 2 years payments. The third payment goes in 12 months from now. So we've got 3 payments in 12 months. So now we're in year 3 already. And now, Paul, to answer your question there, we'd probably have a cash value roughly to what our contributions were. So, maybe 55 grand in would let you borrow 50 if we were backdating it a year.
What are the fees to the policy? In other words, what fees do the insurance companies charge to set up these policies?
Sure. So there's no extra planning fee. There's no extra charge. Insurance companies don't love this product, really. For every other product out there, of those 10,000 insurance products, insurance companies can charge whatever they want, and they can change the fees whatever they want, right? So if you buy a traditional whole life, the investment management fees in there could be anywhere from 1-2%. They could change it next year. The 4 that we use are the actually only 4 money products, if we look at all banks, insurance companies, and mutual fund companies, that are federally regulated. The insurance company or the federal government came in about 50, 60 years ago and said, all right, these 4 funds that are actually owned by the policyholders, the 4 we use, we got to protect the poor widows and orphans, is what they said at the time. We're going to regulate what you can charge for fees. So it's just the 4 that we use are regulated for fees, and it's based upon your size. So for instance, like Manulife is 13 basis points, 0.13, Equitable 0.18. All the others are sort of in the same ballpark, extremely low, but it's federally regulated what they can charge.
Okay, thank you.
If I can interrupt for a second, Gino and Mike, like I asked the same questions. So you're not wrong for asking those questions. When I heard this, I was like, what if I put 500,000 in right away and I just borrow the shit out of it, right?
Yeah.
It doesn't work like that. It's kind of it's kind of like priming the well. Like you kind of have to get it up to a certain point where it makes sense to borrow over a short amount of time. Like I'm in a year. What year am I in? 3, 4? I don't know.
3, I think.
3 or 4 or something. And like I haven't needed to borrow it, but it's starting to get up to a point where it's high enough where it's reasonable and makes sense enough to borrow. Maybe the next year or 2, right?
Yeah, so like a plain Jane policy where we're not front end loading it or doing anything, you're looking at funding this probably for at least 7 years of the next like 20 or 30. I'm not saying you got to wait 7 years to use it, but I'm saying we just can't take 100 grand today and be done with it and say, okay, thanks, you get yourself a policy. We're going to need to split that up or fund it. We can fund it at different levels, but fund it for a 7-year period. If you're sitting on cash now and you want to shorten that distance, we can do it, but we just need to do that up front and start backdating. And there's a couple other things that we can shorten that maybe to like 5 years, 4 years. And again, like when we say 5, 6 years in that backdating scenario, we're in year 3 in 12 months. So again, backdate a year, one payment today, one payment tomorrow, one payment in 12 months. That's 3 years in 12 months. And the other one that I don't know why I thought of this, but the other one people ask a lot is about health and age. What's really cool about this is I actually did this today. I did a presentation and I screwed up and I had a 40-year-old and I showed a 43-year-old. And then I said, I just want to show you the difference. Well, let me use different ages. People come to me at 50 and they go, oh, I should put this on my 30-year-old kid. That would be way better, right? Your cash value as a 50-year-old and your cash value as a 30-year-old in 10 years will be almost exactly the same. Exactly the same. Okay? Because this isn't traditional life insurance. If we're buying traditional life insurance and you wanted $1 million of death benefit, the 50-year-old's paying way more than the 30-year-old. But for this, now I'm going to say something that's not true, but it'll help you understand it. Like this just conceptually. You put $100 into this, into the product the way we design it. Let's say $95 goes towards the cash, $5 goes towards the death benefit. The 30-year-old for that $5 can buy $500,000 of death benefit, but $95 is going to the cash. The 50-year-old comes in and goes, well, I want to do the same thing. Okay. $95 goes towards the cash, $5 goes towards the death benefit. But for the 50-year-old, they can only buy $150,000 of death benefit instead of $500 on the 30-year-old. Same cash value. So this isn't one of those products where, oh, I didn't buy when I was in my 20s, 30s, or 40s. Sure, it helps if you're younger for you more time to keep compounding. But, you know, really, if you're in your 50s, you're not too late. If you're in your early 60s and you've got 5-6 years, either funding, you can fund it for the next 5 or 6 years, or you have plan on working another 5 or 6 years, you're not too late. Even if you're uninsurable, we can use another life. So if you're uninsurable, I own policies on my wife, I own policies on my children. They have no rights to these policies. I own it. I control it. I fund it. I'm the beneficiary. I can cancel it, take the cash. I can borrow it. It's all about who owns the policy. It doesn't matter whose life is involved. Now, I will gift those policies to my children, assuming they stay being good kids at some point, but there's no tax implications when I gift that tax-free policy with the tax-free growth to my kids.
If I can make a recommendation, I think when I was going through it, like the presentation seems very it's generalized, obviously, but and as humans, we're trying to personalize it, and like, oh, how does this fit for me? Like it's impossible. So you kind of, and guys, I don't get paid for this. I'm just trying to give you my 2 cents. Like I'd recommend booking an appointment and then talking with one of Darren's advisors. And then you can ask 1,000,001 questions about how it fits for you, and they can. Like you can do up a model, right, Darren? Like
yeah. So on the first presentation, you're right, Paul. It's going to be a generic presentation, but we're going to have an illustration based upon your age. So when you book an appointment, you're going to have a couple email or a call from someone asking you a couple questions like, how old are you? Are you in good health? What are you doing now? Like 3-4 questions. And that's not because all because we just, that first presentation, we're going to have a generic, how does it work? Answer all your questions. And then we're going to show you a specific example for your age.
Yeah. So that's what I would recommend doing. And then at least at that point, you'll have something to digest, and then you can sit on it, look at it for a while like I did, or say yes, or say, ah, this is not for me. And then at least you know, and this is, you know, it's off the table. That's the important thing I want to stress.
And it's the least amount of pressure. We consider ourselves financial educators. There's all kinds of people that want to do this, and there's people that don't want to do this. We educate the shit out of people with books, resources, and that first presentation. And at the end of it, you go, great, thanks for letting me learn. Have a good day. I appreciate it. Or, oh my God, this is the greatest thing ever. Sign me up. I'm in. So there's going to be no pressure on that call. It is really an education session.
Hey guys, thanks. I just had a quick question here. Thanks, Paul, and thanks, Darren, for putting this on. It's, really valuable information here we're talking about. Darren, I had a quick question. What have you seen as kind of like the minimum monthly premium that someone is putting into this sort of product here, or this sort of plan? I mean, you mentioned, like if, as an example, if you're putting in $25,000 a year, right? I know that breaks out to just over like $2,000 a month, but what is kind of like the minimum a premium that you've seen someone putting in a plan like this?
Yeah, so I think that's a great question. So I believe if you can't fund this at $500 a month, you shouldn't do it. And not that we don't want to help you because you don't have $500 a month, but I look at it, if you're not saving at least $500 a month, then you need to work on either growing your income or reducing your expenses, hopefully growing your income. And then you can get to this at some point down the road. So at that point, yeah, if you still need insurance, great, buy some cheap term insurance. Now, I'd be very specific about the term insurance you bought. If you talk to one of us, we'll tell you which company to buy, because you can take that term and convert it to a whole life later. But $500 would be the minimum. At that, anything under that, you're not going to build up enough cash value to actually use it for something. So that would be the minimum. Our average would be around 20 to 25,000 a year, or $2,000 a month. But 500 where it makes sense, 100 grand a year makes sense. $1 billion a year makes sense. There's no limit on this. On the upside, down on the low side, I'd say 500 a month.
Okay,
Hey,
awesome. Thank you so much.
hey Mo, it'd be good if you do it for your kids, man, or buy it on them. That'd be a good one.
I know, I know. You know what? I've been thinking about this for a long time now, and I think I did reach out to Darren's office once in the past, and a lot of valuable information. It was a great call. She was a fantastic lady that helped me out, and I'm still kind of like on the fence, kind of debating this, but that's a good approach. And I didn't realize that you could buy like a term policy and turn it into a whole life in the future, and then yeah, like trying to put a policy on, for the kids, right? I mean, yeah, these are all questions I think I have to get into next.
Yeah, kids got to be 14 days old is pretty much it. And again, beautiful tax laws in Canada. So all the growth, grows tax free. You will own it until you decide to gift it to your kids, or you could gift it at death. And what I love about the kids is, so right now, my policy on my kids, I'm benefiting from if I want. I haven't accessed loans from that, but I'm benefiting. My kids are going to benefit from the cash value because I'm going to gift that policy to them to help to buy their first house, first income property, first business, whatever. My future grandkids that aren't born, and I'm in no hurry to see them yet, my future grandkids are going to benefit from that policy because the death benefits on my children. So they're going to benefit. So now we've got 3 generations benefiting from this policy. You do that for your grandkids, or you get your kids to do it. Now we've got 4 generations, and your family's going to be philanthropists. Like with that many death benefits coming in, it's crazy, the numbers.
And if you do end up putting a policy on for your kids, I mean, what sort of is like the minimum sort of monthly premium that we're talking about? Is it still 500, or is it
Yeah,
different?
no, you can do 150, $200 for kids, something like that. No problem.
And then
At
it's
least
still like a 20-year range, like you're paying that for 20 years?
you should pay for 20 years. You can stop paying probably after 7 or 8.
Huh.
And it's flexible, right? Like if you paid the first 2 years and then you took a couple of years off, and then you came back for a couple of years, took a couple of years off, then went back and made up those payments you missed for a couple of years. Like there's all kinds of flexibility, especially there's really, the flexibility starts after year 2, because that's when we design it by the end of year 2, you've got enough cash value built up that you can survive the storm, right? So if you had to go 5 years without making a contribution, you're okay. But you've got to get to year 2. So if you're paying annually, that's only 12 months away.
Thank you.
Anybody else with questions? Or someone raise their hand, Dwayne?
Hey, can you hear me?
Yeah, go ahead, Dwayne.
Oh, perfect. So I get myself one of these policies. If I can I fund it like initially with one lump payment, 150?
No, kind of, sort of, maybe not really. What we do there is we'd say, okay, let's take that 150 and we'll split it up into 3 payments. Maybe we'll take 100 now and 50 in 12 months and get it in that way. Because if we put it all in 1 year and we'll try to one lump sum, what happens is we got to drive the death benefit up to a point that the insurance costs are going to get too pricey, because you really only need that death benefit for year 1 if you're putting in all your money year 1, and then your death benefit's going to stay high. So we want to get that death benefit as low as possible. So that's why we try to split it up. Now, again, we could say take 100 grand and then 25 grand a year after that, or something. Like there's ways we can do that, or we can take two years up front, but we couldn't take one payment and be done.
Okay. Because the main question I had after that was, I pass on, am I able to name a trust the beneficiary of the death benefit?
Yep. And there's always going to be money left over, because even if you have a loan, so the death benefit's always going to be the big number. The cash value is going to be smaller, and the loan is going to be smaller because the loan can only be 90%. But the beneficiary in Canada, you can name anyone you want as the beneficiary, including a trust.
Gotcha. Okay. Okay, thank you.
Hey guys, just one more question here. I'm curious, Paul, Darren, have you guys seen anybody, when it comes time to like, and when the time comes that they can refinance, like they actually like refinance an existing property, and then instead of maybe purchasing another property, set aside that money to fund this policy? Like, have you guys seen that happen before, or is that a common strategy?
100%. Yeah, all the time. People
Really?
sell a property, refinance property, and do this, and people get lines of credit to fund this. Now, my belief on this is, I got no problem funding the first couple years, whether it be a refinance or a line of credit. You just can't fund it like that long term, right? Like, it doesn't make sense to borrow money to fund this every single year. But if you want to jumpstart your policy and you're able to refinance, throw some money in, or a line of credit, and again, general terms here, your wealth coach would go through the particulars, but oftentimes that'll make sense. Sometimes it won't, but oftentimes that'll make sense. But just don't plan on borrowing to fund it every year. That doesn't make sense.
Okay, thanks. Yeah.
Who else? All good questions. I asked all the same ones, by the way.
You're a smart guy.
So
Yeah.
I'll just quickly go over that term insurance, and why we only use those four companies. So if I was going to buy term insurance today, so I would use one of the four companies we use, because every term insurance contract has what's called convertible without medical evidence. So if I have a term insurance, say with Manulife, I can, in 6 months, even if I'm not insurable or don't want to go through a medical, I can turn that term insurance into a whole life. Now, if I bought my term insurance through RBC insurance or ABC insurance, I have convertible option there, but they don't have a participating whole life product to convert to. So if you try to buy a term insurance that's not one of the four companies, then all of a sudden, a year or two from now, you want to do whole life. Well, you can't convert your policy. You've got to apply for a new one. And if you're not insurable, you're in trouble. You're not going to be able to get one. So even your term insurance should be with one of the companies we deal with. And if you have a current insurance policy, yeah, we can take a look at that. 99.9% of the time, it's not gonna work because it's not with the right company, you're not set up right. But we're happy to review any policies you have.
So if you don't have that website, I mean, I'll email it out with the recording, but I'll put it through the chat here again. Just go to the website and you can book a call. I recommend, then you can ask 1,000,001 questions to the guys and gal, and get it all personalized for yourself. I think if there's nobody else, we'll call it a night. And oop. Someone was trying to chat there. Go ahead.
I think they put themselves on mute.
Oh, was that Helen?
Yeah. Can you hear me now?
Yes.
I can hear you. Yeah.
Yeah. Hi, Darren.
Hi.
I have a small business. It's incorporated. It's an active business. So we kind of sell products. So you mentioned that the policy has to be in under active business corporation, not under HOCO. Is that right? I didn't
No.
hear you clearly at that time.
Yeah, sure. That great question. So, so corporations, are you in Ontario, Helen?
No, I'm in BC.
BC. Okay, perfect. We do lots of work in BC. Our number one province is Ontario, 2 is BC, 3 is Alberta. So I think in BC, you're 11-12%. So
yeah,
you're in $1 in your corp, you pay your 11-12% tax, you're left with 88 cents. We can put that money right inside the policy. Ideally, we're going to take that ideally, we'll take that 88 cents and we'll slide that over into the holding company, and we'll do the policy in the holding company. What I said originally is, if you just have a real estate company to hold your real estate, then you didn't have the operating company to get those 88-cent dollars.
Oh no, it's an opco. It's not a real co. Yeah.
So if you have an opco, you should do a corporate policy.
Okay, and the whole co, right?
Inside the whole co, yep.
Okay, that doesn't ruin the lifetime capital gain exemption eventually, right?
Right, exactly. So you don't want to keep
Okay.
it in the opco because if the cash value grows too big there, it's going to be treated like an asset, no different than your bank account. You don't want to have
Right.
too much cash in for your capital gains exemption. I have a
Oh,
whole
I see.
podcast on that if you want to check it out.
Oh, okay, on your website, is that right?
Yeah, or just go to our podcast is Control and Compound on any podcast platform, and all the
Okay.
podcasts are on YouTube as well.
Yeah, okay, great. Thank you so much.
Thanks for the question, Helen.
Thank you.
Hey, no problem.
Good question.
Anybody else? Don't be shy.
I have one last question. Are we better to put money into an RSP or better to put money into this product?
In
Gino,
this
I think you should
product.
write me a
In
check
this
every
product.
month.
Well,
What's that?
would you start a business with this guy if he told you, here's the business I want to go into with you. You put up all the money, you take all the risk, you pay all the fees, you have no control, and in 30 years I'll let you know who owns what.
Yeah.
Sounds like
Who's that
bullshit to
question
me.
directed to?
That's an RSP right there. You put up
Okay.
all the money, you take all the risk, you pay all the fees, you have no control. And then in 30 years, the prime minister of the day will let you know whether you get to keep 30 or 40 or 45% of your RSPs, and they're going to keep the rest. So I'm not a big RSP fan when it comes to business owners and real estate investors. If you're a regular T4 employee and you want to throw a little extra money in your RSP, have at her. But my belief is, because I studied the wealthy say we want to make money investing in ourselves, business and real estate. And to do that, you've got to be in control.
You've answered my question.
Doesn't make you a bad person if you put money in RSPs. I still have RSPs. I just haven't contributed in the last 15 to 18 years.
Well, the reason I'm asking is I'm still thinking like an employee earning six figures, paying 53% tax. And now I've left that employment and I'm going into self-employment where I'm earning zero. So got a lot to think about here, Darren.
Well, this would be a wonderful time to take some RSP money out. It's the best time to take RSP money out. Well, again, talk to your advisor, but I always say the best time to take RSP money out is when you're in a low tax bracket. And are you
Right.
ever going to be in a lower tax bracket than you are today?
Probably not.
That's exactly what we did.
Yeah.
Yeah.
I always thought that was a funny pitch as an advisor. You go into someone, in their 30s and you go, listen, you work with me for the next 35 years and I'll tell you what I'm going to do. Keep investing your money and I'm going to make you poorer in retirement than you are today. And you're going to be in a lower tax bracket. Doesn't that sound fun? Like, I want to be rich in retirement. I want to be richer than I am today. Like, the idea of trying to get in a lower tax bracket in 35 years when you've accumulated all your wealth. Like, I've got business owners that beg me every year, just please don't make me take money out of my RSPs and pay 54% tax. And you think 54 is high? Get this. So let's say that you're in Ontario and you're making 85 grand a year. Okay. Not really rich in Ontario. You're making 85 grand a year and you're 65 years old. And you take $1 out of your RSP. You're going to pay 42% marginal tax. And you're going to pay an additional 15 cents in tax called the old age security clawback. Because if you're 65 and your income's over 85 grand, every dollar you make or every dollar you take out of your RSPs, which shows up as income, you're going to pay 15 cents of that back to the government. So now you're in a 57, 58% tax bracket. Can you imagine putting money into an RSP today in a 0% tax bracket to take it out down the road in a 57% tax bracket?
Read this book to Gino, RSP Secret. Okay.
Did you write that book?
No, I did not.
I'll read that book too.
I hate RSPs. It'll make you poop your pants enough to know that it's not the greatest idea for your situation. You're going to become a nice developer. Never mind RSPs. I promise you're going to make more money doing with the stuff you know how to do than RSP.
All I know is what I learned from tonight is I need to talk to Darren.
Yay.
Yeah. Okay, so mission accomplished. Okay, well, good questions. I mean, don't be shy. Anybody else?
What's the name of that book again? Sorry, you were too quick. You took it away.
RRSP, the RRSP secret. It's written by Greg Habstritt. It's an older book. It's probably 15 years old or so, but still makes sense.
I was too busy earning money and paying taxes to really think about how I'm going to save on my taxes.
I know
but-
you're not the only one.
Exactly. But I go back to like, again, that guy that laughed at me when I told him to do an RSP, like that was a true story. And like, I find, I'll be honest, like I'll tell you the inside goods here. It's so much easier for us when we deal with someone that's wealthy because they come knowing traditional financial planning isn't for them because that's how they became wealthy. Because they didn't follow the herd. They didn't work a 9-to-5 job and put an extra $100 in the RSP every month. They did something that traditional financial advisors aren't going to tell you to do. They took risk and started a business or real estate or did something non-traditional, and that's how they became wealthy. So when they come to us, they don't give a shit what you call it. If it can grow tax-free, access to tax-free, the death benefit's tax-free, allows you to multiply your money, it's creditor protected, versus somebody that comes from a T4 background. Well, I don't know. Everyone says RSPs are good, and because they're stuck with the herd. And I always say, we've got 10% of the people that control 90% of the wealth. Okay. But for some reason, we don't want to listen and follow their strategies. We want to follow the strategies of the 90% of the people that own 10% of the wealth. And those people are doing RSPs, and because that's what everyone does. I don't want to do what everyone does.
We've been brainwashed, Darren.
100%.
Yeah, where were you 30 years ago, man?
I was putting money in RSPs because I didn't know any better.
I hear you, brother. Okay, that's been a great session. Thank you for your time, Darren.
Yeah,
Thanks,
no
guys.
problem.
Appreciate it.
All right. If that's it, we'll call it an evening. I mean, I just put the link through again. Someone just asked, where do we get a hold of Darren? And just go through the link and book a call. And then you can spend an hour or so talking to Darren or one of his advisors. That's going to be the easiest way to get through it. And they'll build a model for you based on your age and all this kind of stuff. So yes, I will share the recording. You missed the whole thing. That's okay, Teresita, I forgive you. No, we'll share the recording. It's all good. Elsa, yeah, no problem. Yeah, okay. So let's call it a night. Have a good night. I'm gonna pass
Thank you
out
so
real soon.
much. We appreciate
Thanks,
this
everyone.
webinar.
Have
All
a good
right.
night.
Bye.
Ciao, 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 ciao.